Hi, Professor Pearl. I'm Ahmed, and my group members are Abbas, Minashan, and Alex. Our topic is financial liabilities, and the companies that we're presenting on include Timber Creek, Aecon Group, Morneau Chappelle, and Cineplex. Now, the first core topic of discussion is going to be the accounting policies for each firm. We'll also talk about the similarities and differences for the accounting policies, as well as financial statement presentations and note disclosures. We're then going to talk about the ASB standards for financial liabilities, and finally apply what we've learned about those standards by recasting the financial statements. So let's talk about Timber Creek first. Timber Creek recently became a public company by issuing their shares on the stock market, which means that they don't have a lot of financial liabilities currently. One of their perhaps main ones and most valuable ones are convertible debts. Now, convertible debt is anything that can be converted into shares at a later date, either at the investor's options or the investee's options. They treat all of their convertible debt as compound instruments, which means that they're both debt components and equity components. Now, debt components are measured first, and whatever is left over is allocated to equity. The liability components are essentially measured by looking at the values of liabilities that are similar to the ones that they're issuing, and whatever that is what they use on their balance sheets, and the remainder is allocated to equity. Transaction costs are under IFRS are capitalized if the subsequent measurement is going to be done based on amortized cost. In Timber Creek's case, their convertible debt is measured on amortized cost, so they do capitalize all of their transaction costs. In terms of any gains, losses, or interest, they all simply flow through the profit and loss statement. Now, the next financial liability are the dividends payable. Now, when a company declares a dividend, they simply record it as a dividends payable for whatever amount they've declared it at, and it goes on the balance sheet. It's a pretty short financial liability. Now, their next one is a credit facility. A credit facility can simply be thought of as a line of credit. So Timber Creek has a certain amount that they can borrow, and whatever the amount is that they borrowed is recorded on the balance sheet, less of any amortized cost for the year. Finally, their last financial liability are mortgage syndication. Mortgage syndication is essentially a loan that has more than one lender attached to it. So a bunch of different parties contribute their portion of a particular loan and give it to another individual or another entity. In Timber Creek's case, what they do is they take their portions of mortgage loans and they transfer it to other entities. Now, generally, this would trigger derecognition, but in some cases for them, they retain the credit risk or the default risk, and in that case, they can't derecognize their mortgage syndication liabilities just yet, and that's why they have that on their balance sheet. Now let's talk about Aecon Group.
So Aecon has a number of financial liabilities, including bank loans, accounts payable, leases, decommissioning assets, and convertible debts. The bank loans and payables are fixed payments that are not on the active market and are discounted using the effective interest rate method if the obligation is over 1 year. Aecon also has a bank indebtedness account representing their line of credit. The lenders have first priority ranking on the security interest, and the loan is recorded at face value. Transaction costs associated with payables and bank loans are added to the liability amount rather than being expensed. The asset decommissioning costs related to the pits and the quarries are to be settled in 2015 and 2018, which are discounted at a rate of 4.77% to find the present value of this amount. The convertible debts are accounted for as a compound financial instrument and as part of equity and part debt. The 2015 and 2018 bonds issued are financial instruments, and both have the option to be converted into common shares at the shareholder's option. Both bonds have a set date when they can be converted at the earliest, and the 2015 and 2018 bonds have also specified conditions to repay the outstanding principal through the issuance of additional common shares. The company can also pay their interest payments through additional common shares as well. The debt portion of the bonds are present valued using the effective interest rate method, and the 2015 bond is mainly a derivative component with fair value adjustments, and the 2018 bond is valued with part debt and equity. The debt is valued using the effective interest rate method, and the equity assigned to the residual value less income taxes. Aecon has two types of leases, operating and financing leases. Their operating leases are defined as leases that represent significant risks and reward of ownership retained by the lessor, and the payments are done over a straight line basis. Their financing leases have regular criteria under IFRS and have them recognized as a debt and asset. As for Aecon's financial statements, they provide a lot of disclosure on their liabilities, including specific amounts given out for their bonds many years ago. Aecon's balance sheets are very disaggregating, allowing to see their specific amounts. However, their income statements are very aggregated and clumped together, so we cannot see their specific amounts. Aecon also provides information as their percentages used to calculate their present values of their liabilities, and the dividends payables are also paid and recorded as declared. As for Cineplex, they have many of the same financial liabilities as Aecon. So Cineplex has a bank loan maturing in 2018 to be paid full at maturity, and they used a floating interest rate to record their interest payments, and they recorded using the present value with the effective interest rate method. Their liabilities for their equipments are over a year and are recorded at amortized cost from cash outflows at their incremental borrowing rate of 2.7%. For convertible debt, Cineplex has an outstanding bond maturing in 2018 with interest payments semi-annually. The bond holder also has the option to convert the bond into common shares at a price of $56 per share. Due to it being at the shareholder's option and being at a fixed price, the conversion rates are an equity. The loans for the restrictive covenant management, such as liens, paying out dividends, mergers, acquisitions, and guarantees. Cineplex also has a cash flow hedge in the terms of interest swap agreement, which is accounted for using hedge accounting and is valued at fair value with changes going to income or OCI. For their leases, they have operating and finance leases and have no options under IFRS to choose which of the type, and if it's a finance lease, it must meet at least one of the criteria, and otherwise it is an operating lease. Cineplex also has leasehold improvements, which have them amortized over their useful life, and dividends payable are recorded as declared to their specific amount. As for the presentability of Cineplex's financials, they disclose a lot of information regarding their commitments, guarantees, and they provide terms for their bank loan, which has put them on a restrictive covenant, which is important to investors as it stops them from paying out dividends. All in all, Cineplex financial statements are very transparent. And now I'd like to pass it off to Abbas.
Hi, so now we're going to talk about Morneau Shepell. So essentially over here we're looking over at convertible debt. So as we must know, convertible debt is a compound financial instrument issued by the company that comprises of debt and equity components. The liability component of a compound financial instrument is recognized initially at the fair value of a similar liability that does not have an equity conversion option. The equity component is recognized initially as the difference between the fair value of the compound financial instrument as a whole and the fair value of the liability component. Subsequent to the initial recognition is the liability component of a compound financial instrument is measured at amortized cost using the effective interest rate method under IFRS. Interest, losses, gains retaining to the financial liability are recognized in the profit or loss section. The next liability we'll be looking at are promissory notes. The promissory notes are financial instruments carried at amortized cost whose carrying value approximates their fair value. The fair value is determined based on the market rate of the interest that would be changed on similar promissory notes issued by a company with a similar risk profile level 2 of the fair value hierarchy. Cash and bank indebtedness is the next liability. It's comprised of bank balances and balance deposit notes with an original maturity of 3 months and are primarily held in Canadian US dollars. Where the cash is in net overdraft position, it has been presented in bank indebtedness. Financial statement representation. Statements are well organized in the annual report with reference to the note section, we'll explain a bit later. For the balance sheet, statements are presented in a consolidated format, so 2013-2014 comparison. Liabilities presented in current followed by non-current liabilities. References to the note section for current liabilities are given beside the account name. Statement of cash flows. Changes in accounts under the liability section is shown under the operating investing activities such as provisions and dividends. In note disclosure, we have a section called Summary of Significant Accounting Policies, which is under Note 3, in which they discuss their accounting policy treatment for certain financial liabilities. Certain sections are very detailed, especially convertible bonds and financial liability instruments. Valuation treatment for those sections. 3 value level hierarchy is shown there as well. It's basically the fair value level 1, 2, and 3, and they're all shown there as well. Moving on to similarities and differences now. So similarities in the financial liabilities for the 4 companies. The first one being financial liabilities. All 4 companies determined the classification of their financial liabilities at initial recognition at fair value. Subsequent recognition is at amortized cost using the effective interest rate method as shown before. Amortization arising from, yes, as mentioned as well. Any of the amortized finance costs are shown to the statement of comprehensive income. Convertible bonds, are shown as well. They both have debt to equity components as well, and they're calculated using the residual method. Financial statement, no disclosure. All 4 companies do roughly the same thing, very organized, consisting of the balance sheet, income statement, statement of cash flows, and changes in equity. And a note consisting of significant accounting policies is present in each report, which summarizes the treatment for major financial liabilities such as convertible debt as well. Cineplex and Morneau Shepell have certain financial liabilities in the other section, and Aecon has detailed the majority of its financial liabilities. So now we're going to be moving on to basically the accounting for financial liabilities using the ASPE.
Now, there are several differences between ASPE and IFRS in terms of the treatment of financial liabilities. The first one is that amortization can be done on a straight line basis or the effective interest rate method, and it's all done according to the company. So generally, straight line is easier to implement, and that's why companies prefer to use that. However, in our case, we have chosen to stick with the effective interest rate method. Another difference is that whenever shareholders provide loans to the companies, rather than it being considered a liability, it can be considered an equity as well. Companies can also set an equity portion of 0 for their convertible debts. Some other differences include under ASPE, there is no OCI or statement of comprehensive income, which means that it's either fair value through profit and loss or it's amortized cost. And lastly, income taxes, there is no such thing as a deferred income tax liability or deferred income tax asset, and everything is done based on, the liabilities are created based on how much they actually have to pay to the government. Now let's move on to the recasting of the financial statements.
So the recasting of the financial statements pertains particularly to the convertible debts, as was inadequate information for other liability accounts. Also, the major ASPE differences in terms of liabilities is the use of the effective interest rate method. For convertible debt, we opted to treat the equity component of the instrument to 0. So I calculated the convertible bonds using the straight line method, and this calculation requires the amortization of the discount premium over the bond equally over the life of the bond. The difference between the amortization and the coupon of the amortization is the interest expense. There's a difference in the face value of the bonds as shown below, along with the change in the interest payments. The change in face value reduced the bond's value after amortization, but also changed the equity account, resulting in the same overall final balance. The interest payments were slightly higher, resulting in a lower income marginally. The change in equity value of the bond also changes the statement of changes in equity, which shows the new value of the convertible debt and changes the other accounts according to that. Lastly, a higher interest expense creates a greater cash outflow in the statements of cash flows and lowers cash overall. So for the financial notes in ASPE, it requires that specific amounts of the present value of the fair value of the lease assets to be at least 75% in PV payments towards the lease that classified as the financial lease. It also requires another criteria for account to have lease terms at least 75% of the assets used for life as well. The restated notes will contain the new face value of the bonds after using the effective interest rate method and show how these numbers will be derived. This is it for our presentation, and thank you for listening.